Welcome, welcome, welcome. Imagine my shock when I woke up this morning and Amazon was under $170 per share. Amazing. So I definitely use this opportunity to grab a few more shares of Amazon. For anybody that's wondering, I think that this far below 200 is almost certainly a gift. I believe it's only a matter of time before the market realizes that it's a steal. Below a 17 times price to operating cash flow today. The difference between their operating cash flow and free cash flow, of course, is their CapEx, which, it's high, but it can go lower over time and will be a lower and lower proportion of their revenue over time. Amazon's revenue, by the way, I could see this at some point hitting the big 1 trillion annually. There are very few companies where I can realistically look at them and say, I think that they could be $1 trillion revenue company someday. Amazon could be the one. They're just so massive and they're capable of really dominating anything that they branch into. Pharmaceuticals might be next, which is one of the reasons that I'm kind of glad I ejected Walgreens. That and just the traditional retail side of things. If they don't adapt to Amazon's existence, they will go extinct. Let's see. Now, I do think we might have to be prepared potentially for some short-term pain, given the fact that, I've heard jobs numbers could be a little disappointing here. Rate cuts may be on the table. Historically, that's not great for the consumer and for equities. It usually is a sign that there's a recession. But Amazon, I think, comes out the other side just fine. They had record-breaking sales on Prime Day in July, which is funny because they had that record-breaking day and the stock actually fell not long after, which is funny. People didn't really like the earnings. They don't like the capital expenditures, I think. I mean, look at this. $60 billion in CapEx trailing 12 months. That's crazy. But that is sort of Amazon's moat, right? They can drop these tens of billions on CapEx and be perfectly fine. They're still cash flow positive in spite of that. And anytime they decide to pump the brakes on that CapEx, their profitability goes through the roof. On the flip side, I do kind of wish at some point they could turn things around on the shares outstanding. It's not like they're diluting a ton, but I wouldn't mind seeing go the opposite direction at some point, especially if the stock is still cheap. I would like to see them do some buybacks in the future. It's not traditionally cheap, of course. Free cash flow, it's still a high multiple. PE, still a high multiple. But they'll all converge eventually, or at least get closer. They won't overlap exactly because there is some amount of CapEx needed to maintain the lead that they have in the marketplace. It's just a matter of, as an investor, if you think that will pay off over time and they'll keep growing, and widening their moat. So that being said, I was happy to see that I got an opportunity to average in at a better price today. Picked up some Amazon, running short on cash. Now, another one that wrecked me today, although it got better towards the end of the day, was, of course, none other than Medical Properties Trust, which, let's face it, that's what a lot of people are here for. Write in the chat if you're here for Medical Properties Trust. They were down actually like 1.5%, almost 2%, I think, earlier today from what I was seeing. And they seem to be closing in on, or they ended the day almost even, down just 0.5%. That's not a very big swing for MPT. I appreciate that, guys. So I don't think anything like really big has happened today with them. So I think they were only red because the market as a whole was red, just kind of going down in sympathy. I did see some chatter on the Discord, but that's just people poring over different dockets and recordings on Steward bankruptcy proceedings. But if there was any big developments, you would have seen a massive swing in the share price. If there was a really, really bad development, you would have seen it plummet. If there was a really, really good development, you would have seen it skyrocket. These changes that are less than 1% in MPW are they're just the ebbs and flows of the market. Nothing really to see here today. But again, it's my largest position and it was down today, which kind of dragged my overall portfolio, unfortunately. Kind of sucks, but what are you going to do? So, that's a good point. If you're here to hit the like button, you better get to that. It's better to do it early and do it often, as I always say. Another one this one actually disappointed me. PayPal. What are you doing to me, PayPal? I finally was starting to feel like I was smart for being in this stock. And then, maybe this is just a blip. And in a few weeks, it'll be back to going the right direction. But, man, I got in this around $59 and change, which is a pretty good basis, I think, for PayPal. So my Discord's link is in the description. I'll see if it'll let me put it in. And I had somebody the other day tell me they couldn't. They were having trouble joining, and he reached out to me on X. I should check my private messages to see. But yeah, that's Discord for you. I put it in the chat for you. So, and if that link doesn't work, let me know. Maybe I need to generate a new link. But we've got quite a few people in Discord, and yeah, I don't blame you for turning off notifications. Whenever something happens with one of the popular stocks, it definitely pops off, and you'll come back to hundreds of messages back and forth worth of conversations. But there are a lot of good nuggets in there. We have people with literally tens of thousands of shares of MPW, for example, really following the bankruptcy for Steward really closely. And every earnings, there's a lot of people offering different takes. I always listen to the conference calls. So Alex Chris, I think, is doing a great job with PayPal. He came over from Intuit, and I mean, it's funny because the stock is up a lot recently. So now all of the articles have pretty much these really these positive headlines, right? Oh, now that the stock went from $59, $60 up into the 70s, now it's a strong buying opportunity. But it wasn't when it was $60. Only now that it's gone up is it a strong buying opportunity. Is that not interesting? And oh, look, now that the stock is up in the 70s, the transformation is finally here. Isn't that interesting? I actually still think they have a ways to go on the transformation, actually. They're doing well so far. Alex Chris is, I think, starting to show the signs that he's delivering, but they still have a ways to go to fully deliver all the things that he's promising. I don't think they've yet actually shocked the world necessarily, but they're moving in the right direction, that's for sure. And I felt like it was pretty clear that they were undervalued and really had mostly upside all the way from the time where they first hit these prices in the 60s that they were at last fall. The only thing I regret now is not doubling up when they were down closer to 50. But, hindsight is 20/20 when it comes to these kind of things. I mean, all right. Take a look at this. The buyback yield. Almost 5.5% of the shares bought back over the trailing 12 months. How many companies can do that? And at the same time, revenue has been growing and is continued to be projected to keep growing in like upper single digit numbers. And a lot of that growth is Braintree, which is why the margins shrank some, but they actually expanded again. They were stuck at like 39 for a little bit, and in the most recent quarter, they popped. See, they were stuck 39, 39, 39, 39, popped above 40 again for the first time in a while, probably thanks to Alex Chris. Now, we probably won't see them back in the upper 40s again anytime terribly soon, because Braintree is a little bit thinner on the margins. It is the part that's driving a lot of the growth. Though I think they do expect to have a little bit more pricing power since the service tends to be kind of sticky. Oh yeah, I'll look at them. I won't be able to do anything with them live since I will be working at the time. When they come out, or I'll be rather having to get ready to leave for the office at that time. So pretty much when this wraps, I have to go prepare my lunch, then go to the office. So if anything, all I'll really be able to do is a retrospective maybe tomorrow on NVIDIA and Crowd, maybe as a regular video, not as a live. Which that's fine. It'll give me a chance to kind of think things over. And I don't own either of those stocks, so I generally tell people logistics and transportation. I keep it a little bit general, but yeah, that's the industry anyway. But yeah, if you guys want, I'll definitely do a retrospective on NVIDIA and Crowd probably tomorrow after I've had a chance to look over the numbers and such. I don't own either stock, so I'm not like super eager like everybody else to actually listen to the conference calls or anything. Yeah, it's pretty cool. I tend not to invest in companies that are in that space at all because it's very cyclical. If they own their own equipment, they're very sensitive to a lot of different costs, very capital intensive. and a lot of a lot of companies do it poorly, we'll say. So, yeah, Amazon, I know, has that portion of the company that's dedicated to that, but they, I would say, do it better than pretty much anyone else, and they've sort of made themselves almost necessary in today's economy. Like it's hard for a lot of people to even fathom life without Amazon now, and that's great. But no other company that has as much of a logistical element, I think, is as ingrained in people's day-to-day lives the way Amazon is. They're truly remarkable. So, all right. Oh yeah, I was talking about PayPal. Got a little bit sidetracked there. So, I love the fact that they buy back so many shares. And I know they have a good amount of stock-based compensation, but I think it's manageable for the amount of cash flow they have. The buybacks greatly exceed the stock-based comp, and I do think that they've talked about bringing this number down some. And sequentially, it is down. And you can see in the past, there were definitely some higher points. Back in 2022, they had $429 million in stock-based compensation. Can you just say what BEP stands for? I'm not. It's not ringing a bell for me. MPW being sued by Steward. So Steward is in Chapter 11, right? So they are literally circling the drain. They are in the most desperate of possible situations. Oh, are you talking about my cost basis? So my cost on PayPal is okay, sure. That makes sense. So, and I mentioned, I probably mentioned it before you got here. It's roughly 59 and change. I forget what the change is. It might be 59.50, 59.20, something in there. It's just below $60. And as I was saying earlier, my only regret at this point with PayPal is not doubling it and lowering that basis when the stock hit like $51, $52. You remember it got pretty depressed for a minute. Yeah, I mean, PayPal's nice, but like my average cost on MPW is like just over $6, and they're in the mid fours right now, so that hurts a little bit. But you live and you learn, and with MPW, I probably should have waited for them to be lower before starting to get involved. But what can I say? It's a journey. And at the end of the day, I think it'll end up worth more than my cost basis, and I'll collect dividends along the way, and it'll probably be all right. Yeah, it is. It is always 2020. And I care more, actually, about the process of learning and refining and getting better over time than about being correct on any one thing at any given time. But yeah, so Steward is going to do literally anything they possibly can. And their lawyers are basically obligated, right, to try to ensure their client's survival. Steward's lawyers are there to represent Steward and nobody else. So they will do anything they can, even if the merit is dubious, to attempt to make sure that Steward survives. And that means even if they lash out against MPW. Now, what really happened How has it lured you to improve your falling knife play in future? I think if something is in the process of falling and playing out, I think I don't need to be so in a hurry to deploy the cash. However, I also want to say that, we had a chance to get Google at a much cheaper price than today, Meta at a much cheaper price than today, Amazon at a much cheaper price than today in late 2022. And so I think those were looking pretty obvious, and I went long by selling puts instead of just buying shares, which I made a little bit of money, but not as much as I would have by just buying shares. So one, I learned when things are very, very obviously a good deal, to just get some damn shares and not get fancy with options. And two, in the case of something like MPW, where clearly there's a lot of X factors at play as headwinds that could be coming to roost against the stock, to wait and let them play out, because there's a good chance it's going to go lower if it's still in the process of falling and there's still a lot of negative sentiment out there. And some of the negative things haven't necessarily fully played out yet. Like, there were people that could see pretty far ahead that there was a good chance Steward was going to go into Chapter 11. And so if we just waited long enough for that to actually happen, instead of just people to think it might happen, I could have had a much lower cost basis here. But instead, I just got it when it started to look kind of cheap. So, Intel. Yeah, that's it. I'll talk about Intel after we go to BABA real quick, because that was one that I got hammered a little bit today. 2%. I think this was actually by percentages my worst one today. So this is interesting, right? A lot of people are calling it a scam stock, or saying that it's not really worth anything. You don't really own anything when you own this. So the thing that was damaging to MPW's tenants, even Steward, which was terribly managed, they didn't really have many problems until the pandemic screwed up their operations, sent wages and costs through the roof, etc. So the scary thing about that is that obviously we can't control another pandemic coming in and obliterating hospital operators, but we can take comfort in the fact that the last time we had a pandemic that was as widespread and deadly as COVID-19 was I think it was 100 years ago, the Spanish flu in 1912 or whatever it was. So the chances of that happening again in the next few years, next 5-10 years, whatever, pretty low. Pretty low. So that's the kind of comfort I have with that particular thing. And their other tenants are actually doing quite well for the most part. Prospect is maybe an exception, but the majority of hospital operators at the moment have kind of come out the other side from their COVID issues and are doing well, according to sort of general information about how the industry is doing. That's what I've read anyway, that actually very few are going the way that Steward's going right now. But Steward is really big, and it's physician owned and managed, and physicians are terrible businessmen usually. Listen to anybody talk about how good doctors are as far as managing their own investments and their own businesses. They usually are pretty terrible at it. They might be really good at learning and school and maybe performing surgeries or whatever. But as far as actually dealing with the nuts and bolts of business, they tend to suck. Just not something that they have particularly high level of acumen in. Oh, look at this. Silver linings in Alibaba. Wouldn't that be nice? Yeah, the recent earnings kind of sucked, to be honest. Yet the stock didn't plummet. So that's good. But this is another one where, like, it's kind of like PayPal in that the total shareholder yield is over 5%, most of which is coming from buybacks. And I think the dividend is there to try to tell people, like, hey, you really do own a piece of this business. Because that's the big argument against the ADRs. If you're in the US, is like, oh, you don't really have a piece of that cash flow. You're a second class shareholder. And I think by paying out a dividend, they're trying to show, no, you're a real shareholder. Here's some money. Now, it says it's an annual payout frequency, but they recently paid a special dividend, and I got some money from that. And I'm still green on the share price because my cost basis is low. So I guess there is something to be said for getting in cheap. Now, Michael Burry got rid of a ton of other stuff and increased his stake in Alibaba recently. Now, he has about 200 million under management, and Alibaba, I think, is now his biggest stock holding. So you can take from that what you will. But to me, that's an interesting development. Say what you want about Michael Burry, but he is a pretty smart guy. And I think if this stock was an outright scam, he probably wouldn't have like $12 million or whatever in it. Or if he thought that a rug pull was likely. Obviously, any business that has any really strong China presence, the government there can 100% rug pull you anytime they actually want to. The question is, do they view it as being in their best interests to burn people who invest in their companies? I think probably it's not in their best interests in the near term to do so. So I accept that risk that they have the ability to do so for the time being. I think that's the best way to put it. Now, somebody brought up Intel. So why don't we talk about Intel? Yeah, Intel was one of the ones that kind of fell today. Oh, that one was just about as bad as Baba, over 2% drop today. Here's what I take a little bit of comfort in with Intel. From the numbers, right? So 0.74 price to book. Yeah, there is definitely some element of things that trade in sympathy with each other. So, yeah, Intel's price to book, 0.74. Price to operating cash flow, 7.4. They were complacent. I don't think they're complacent anymore, but depending on who you ask, they're investing too late to make a difference and all that. I don't know if I buy that. They may not. They're probably not going to be dominant or number one at really much of anything, but there's, like I say, there's a place for Coke and for Pepsi in the marketplace, and if they can't be the Coca-Cola of chips, they could be the Pepsi. They can be the store brand, whatever you want to call it. They don't need to be number one. They don't need to be the best. They don't need to be they don't need to be the best to be profitable and a good return for investors. People think otherwise, sure, but I disagree with that idea. Now, it's a little bit tough with the fact that the capex is really a drag on free cash flow, but they still have a good amount of operating cash flow. Their price to operating cash flow is only 7, which actually, like, this is somewhat in line with previous years. 2022 it was a 7, 2021 it was a 7, 2020 it was a 5. Now, this does mean that their operating cash flow has gone down, but still, like, would Nvidia ever trade for a 7 times operating cash flow? I don't think so. What by Looney Tunes going crazy, do you mean up or down? I'll take a look and see what Nvidia is doing if you guys want. Uh-oh. Uh-oh, SpaghettiOs. Should have bought puts. That's funny. Yeah. This is actually kind of amusing, to be honest. So, yeah, Nvidia. Oh, Nvidia. Now, hey, look, I'm gonna call myself out a little bit on something. I've been wrong on Nvidia many times. Okay. What I mean by that is, okay, you go back. All right, I started making videos sometime in 2023. Okay. You go back to one of my earliest live streams. It was probably sometime in spring 2023. I 100% said that I thought Nvidia was overpriced. Now, if Nvidia ever reached these prices again, I would put a lot of money into it. So that just goes to show you, again, hindsight is 2020. But what is the actual limit? You can't say for certain, but a $3 trillion market cap, to justify that valuation, it requires quite a lot, and they might be able to. I actually haven't looked at it. Okay, yeah. Okay. Price to operating cash flow 77.8, where I can get Amazon for like 17 times operating cash flow. Granted, this is a lot more capital light, so their free cash flow is a lot closer to their operating cash flow and everything. But if I can get Amazon super cheap, and I think Amazon's is not quite as cyclical as this. You do get like a boost in revenue from like holiday spending and stuff with Amazon, but overall, I think Amazon doesn't have the same cyclicality as this. Much more consistent, still has a very high moat and everything, still growing. I would think I would rather have Amazon than Nvidia any day of the week. I think that's almost too obvious. I'd also rather have Google than Nvidia if we're talking about Mag 7s. And I get that Nvidia does something different than what they do, but what are the chances that you've got 7 companies with these huge market caps and all of them are appropriately priced at the moment at these highs? Yeah, I agree. Yeah, I've been to the Philippines, and Grab is definitely underrated. Eventually people will catch on, maybe. I think maybe once net income on Gap becomes profitable, then maybe the market will start to realize. I think a lot of people miss things because a lot of the market probably really only looks at the surface level metrics. So, the PE is high, I'm avoiding it, or there is no PE. So they don't. So PE is like if the financials, if the the ratios and metrics are like an iceberg, The top layer is PE. That's what you see on the surface. Underneath that, I would say free cash flow, and then below that, operating cash flow. But obviously it goes a lot deeper than that even. But I think for like a top level view, I like to look at the operating cash flow a lot in certain businesses, because the CapEx can kind of hide how much value is really being generated, or what the value generating potential actually is. And with GAAP, you can have a lot of write downs or paper losses or depreciation or whatever, hiding how much money is actually coming in. So yeah, I think it's important to look a little bit below the surface first before you dismiss an investment. But I get it. Like, you run a screener, you get dozens of options. It's hard to look closely at a ton of stocks. But yeah, Grab got hit a little bit today. It was less than 1%, which is why it wasn't in the title or description today. And unlike MPW, it's not my number one holding, so it didn't drag thing. I didn't feel it as much. And plus, a lot of my initial tranches of shares were actually still below this price. Now, I averaged up initially, so now on net, I'm a little bit down on Grab, but I think it'll be fine. It's based in Singapore, so you still have that Southeast Asia emerging market exposure, but no China direct exposure. And I think if you look at the per capita and overall GDP trends in the region, so look at Thailand, look at Malaysia, look at Vietnam, the Philippines, Indonesia, Myanmar, whatever. However, I'm probably mispronouncing the name of that country. I apologize. But look at all of them. Look at their total GDP and per capita GDP and how they've trended over the last 30 or 40 years. They're doing better. They're still poor countries compared to first world, but they're getting better. So I am not in Tesla, and it would take a lot changing for me to be a buyer of Tesla. Okay. I mean, the growth seems to have stalled a bit, right? And let's be honest, their valuation is high. All right. If we're using apples to apples, because obviously Tesla's pretty capital intensive too, the gigafactories and all that, right? So they share that in common with Amazon. Can we agree that they're both capital intensive businesses? Fantastic. So we agree on that. And then we look at, again, the price to operating cash flow. I won't even beat them up for the fact that their CapEx is high and their free cash flow multiple is ridiculous, but just the operating cash flow. So we're comparing the same metric to Amazon, which is also pretty capital heavy and everything. Okay, so we want to pay 58 times operating cash flow for Tesla or 17 times operating cash flow for Amazon. What is the better deal? I think Amazon is very obviously the better deal. And in my opinion, the best deal in the entire Magnificent Seven, and the only one to me, other than maybe Google, that seems magnificent at today's prices. Salesforce, huh? Jeez. Okay. We can do Salesforce. I'm not in Salesforce, by the way. But I will say, like, they are interesting. They're not too terribly they're not ridiculously expensive for what they are. And at one point in time, I was looking at possibly pivoting into a more software sales type role. This is years ago now, when I was in my late 20s. But I looked at many job postings, and every single technology or software based sales job wanted you to have Salesforce experience. They wanted you to know how to use Salesforce to be in those roles, to work at those companies. Salesforce, like, some of them were companies you maybe haven't heard of, but they sell some kind of a niche software. They all use Salesforce. It's ridiculous. And this was, again, years and years ago. And it seems like they've grown since then. I would say that because they're so established, there's probably a moat here. I haven't looked at the Morningstar rating to see if they agree, but it seems moat-ish. And again, price to operating cash flow 21, so that's not so bad. Price to sales of 7. I mean, for a good, solid software company, that doesn't seem overly high. I wonder why their net income is so much lower than their cash flow. I bet it's stock-based compensation. That's probably what it is. Yeah, they have a lot of stock-based compensation, I think. $750 million in the last quarter in stock-based compensation. That might it explains some of it, not all of it. I mean, they've got pretty high SG&A too. Ugh. I do have a little bit of a problem with companies that have excessively high SG&A. I mean, this might not be excessive, since once they get a customer, I think they probably have recurring revenue, so maybe this is a good investment for them. But at this point, it's weird that it's staying higher. I mean, higher than it was years ago, when I think at this point everybody's heard of Salesforce. So how is it they need to spend this much to get the word out? That's kind of weird. But maybe somebody that actually follows the company can, yeah. Maybe it's something that somebody that follows the stock can explain. But I think what I would want in order to get into Salesforce would maybe lower SG&A, lower stock-based comp. And of course, for which I would want their beautiful, beautiful growth to at least somewhat continue as well. So that's where I'm at with that. But just like any software company, they've got beautiful gross margins. Those probably are not going to erode anytime soon. But yeah, it seems like there's some places where they could trim a little bit of fat to drive up the bottom line. Which maybe they'll do when this growth starts to slow down. They might just be keeping the pedal to the metal on the SG&A and the stock-based comp as long as the growth stays in the double digits, and then maybe when it starts to kind of peter out, they'll dial back the SG&A and trim some of the fat. But yeah, Salesforce could be a really good investment today if they can keep this growth up for a few more years. I mean, can you imagine they keep this growth up for a few more years and then they trim the fat and it ends up being to where you paid like 8 or 9 times what they're producing in cash flow in like 2027, 2028 or something like that. In retrospect, you'll probably have been pretty happy. I do wonder. I always wonder what the analysts are projecting. I mean, they're talking 9.5% revenue growth with. Oh dang! They expect EPS to really take off here and get to $10 per share and then still grow double digits for a little bit. Okay, that's pretty good. It's not too bad. It's not too bad. Let's see. So, actually, funny thing, and I wouldn't have expected this, but High Tide was actually up today. I know. Very surprising because they went down obviously when it came out that the rescheduling hearing was getting pushed back to December. But this is a small cap, so I don't necessarily expect there to be a ridiculous amount of news coming out, but let's see here. All right, so they're releasing their results on September 16th, so that'll be interesting. I will probably be listening to that earnings call as long as I'm awake. So, hey, I mean, I'd consider doing a live stream for High Tide's earnings if people wanted. Oh, Paul. Let me. Oh, okay. Paul, look. 7 times free cash flow. Canadian cannabis companies are a minefield because most of them hemorrhage cash. This company generates abundant cash for their size. They are a small cap. But this is a well-managed business. Dilution is a little bit of an issue for sure. But, I mean, they've managed to flip into positive free cash flow over the last couple of years. Yeah, but, I mean, did they ever have cash flows or did they only ever have hopes? That's the problem. This isn't about hopes. It's trading for 7 times free cash flow. And by the way, they're at 11% market share. And they are expected to hit 20% market share. That's their like kind of overall goal in Canada. I think at 20%, they're pretty much, they're probably not looking to go too much past that because I would imagine Canada probably has something to say about possible monopolies. So, yeah. But no. This, to me, this doesn't look like a minefield. I'm not saying that it's completely safe. It's certainly volatile. Small cap, like the trading volume on this is so low that the stock can swing hugely if somebody makes a big buy or a big sell. Yeah, there is definitely some stock-based comp, which it's not huge, but it definitely eats into any possible net income, and there's a lot of depreciation, etc. but their objective is to reaccelerate growth while maintaining positive free cash flow. If they can do that, they can balance that out, then I like it. Yeah, I mean, I don't know. I don't even know Canopy. Like, this is, other than Kronos. Is this CGC? Is this Canopy? Yeah. Okay. Why don't we just see what this is all about? Okay. Yeah. So no net income, no free cash flow, no operating cash flow. This just burns cash. That's the big difference for me. If they just burn cash, they burn cash, high tide generates cash. That's a night and day difference. So, we'll call it a 10-minute warning. I'm going to get off here after about the 1 hour mark. So, if anyone has any last minute requests, now's the time. We've talked about Amazon, we've talked about PayPal, Alibaba, Medical Properties Trust, Salesforce, Nvidia. Now we've talked about High Tide and Canopy. So we've gone from the Magnificent Seven. Oh, we talked about Tesla as well. Speaking of the Magnificent Seven. So we've gone from large cap tech all the way to small cap Canadian cannabis on this live stream. We've covered so much ground. It's very fun. I personally actually enjoy doing this, I think, more than like creating videos and then uploading. Am I still buying MPW? So MPW is the top position in my portfolio, and I feel as though I'm fully allocated. Every once in a while, I will randomly pick up a little bit more, but I don't have any current plans to substantially increase my MPW. Now, I feel like I'm more in the stage of letting it play out. I have a good chunk of shares. Obviously, there are people in my Discord that have many times the amount of MPW stock I do. We have people with, let's see. Well, Stabulo has like 10,000 some shares. And Leaf has, and he's usually in these streams as well, in the chat, but he's probably busy today. But Leaf has like, I want to say like 50 to 60,000 shares, maybe more. Because he always has drip turned on. So every time the dividend gets paid, he picks up a bunch more. So yeah, he's got a lot. It's like 300K or something in MPW stock. So always interesting to hear his perspective on stuff. He's got some serious stones to hold through all of the noise and the turbulence on MPW. So, yeah. With that though, I'm not really that eager to keep adding MPW, since right now my goal is to get to 100 shares of Amazon while it's below 200. I do think that Amazon only stays below 200 for a certain amount of time. And once it gets to that level again, could be off to the races, and I don't want to dilly-dally. I'm also trying to accumulate Disney while it's still below 100 as well. Which, by the way, maybe that's one to take a look at real quick before we go. So I got hit a little on Disney today too, but it's further down in the portfolio. Only got like 50 shares or something. But it's not like a crazy fast grower, obviously, right? Something happened to their revenue in 2020. I wonder what that was. But, 2019, okay, they were doing $19-20 billion a quarter. Now it's more like 22-23 billion a quarter. So, yeah, you're not going to get necessarily insane revenue growth at Disney, but I think the main thing was, do they get back to where they were in 2019, right? Before the pandemic issues dragged their share price down. Which is actually funny because before the pandemic stuff made their share price drop, it actually inflated a bunch because people thought Disney Plus was going to be basically on its own the same value as Netflix because subscriber growth was crazy during the pandemic. It's weird the market did in 2021, but Disney is interesting because it seems like the effects of things always happen like as a delayed reaction, which creates an opportunity because the pandemic actually really crushed them in terms of their parks and their cruises. But since Disney Plus was doing well, the market like ignored that completely and just assumed that the minute that that the pandemic kind of wrapped up, that things were just going to immediately go back. And it takes a little longer because they still had costs with maintaining the parks and the cruise ships and stuff. Like they still there's holding costs on assets like that. And so the financial fallout takes some time to clear. And when you look at the margins, that's kind of where you see the what's going on, right? So operationally, they were in the 13.5% operating margin range by the end of 2029 or 2019, not 2090. That would be kind of funny. That's the future. But they got back up to that level this year and now are actually closer to 15% operating margin. So actually their operating margins are now back at and or above the old level, which I think is what anybody that's bought Disney below 100 in the last couple years, they've been anticipating the margins getting back to the old level. Now, oh God, now even profit margins are kind of, with the occasional off quarter though, but they are basically back. But there was one negative quarter and then 11.32%. So I think that they're back. And the market just hasn't realized it yet. Or it's the culture war stuff, the go woke, go broke mentality. But they also turned profitable on their streaming segment. Barely, but they did. And as time goes on, that should get better and better. And with Netflix, you do see what happens as time goes on when somebody is running profitable on streaming. So I'm very strongly encouraged by where Disney's financials are going. It's a little slow and a little incremental, but everything with Disney seems to be like a lag effect. And if the operating margins are back close to 15%, then I think it's only a matter of time before the market realizes, oh, Disney still has a high moat and still produces a lot of money. And it's, a good investment, basically. And I think it's probably not worth more than like $120, but it's trading for a lot less than that right now. So I'm happy to take the journey, and it's been around for 100 years and probably will be around for another 100. So there you go. All right, so I'm at the 1 hour mark. I'm going to wrap up with the usual spiel of join the Discord, link in the description. If you haven't hit the like button already and you've been on the stream here, I don't know what you're doing. Make sure you're hitting the like button so it'll get recommended in the algorithm after it concludes for the playback. Also, if you're not subscribed, I'd appreciate it. I'm trying to get to 3K. I'm also trying to get to 500 X followers, formerly known as Twitter. You can definitely find the link in the description there as well. And sometimes there are people out there that wish they could show their support for the channel in a direct way. Well, being a member definitely does that for you. And it definitely gets you a bit of a priority in response to questions, comments, requests, and what have you. I like to take your opinions into consideration if you're taking that step. Starts as low as 99 cents because I don't do it for the money. As always, I appreciate everybody for tuning in and participating in the chat. I think it generated an interesting discussion today. And tomorrow I'll probably put out something about CrowdStrike and NVIDIA, so keep your eyes peeled for that. Looking forward to it. Have a wonderful day, everybody.